Hey Bowtie Nation, Joseph Hogue here, back after the hurricane with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And it was a whipsaw week for tech investors when the early release of an ASML earnings report spooked the market that the rally in AI stocks was coming to an end. Shares across the space, including Nvidia, sold off along with the semiconductor equipment manufacturer before jumping higher on a surprisingly good report from chipmaker TSMC. That dichotomy points out the difference in the chip market between those capable of running the AI models and then those for other uses like cell phones or laptops. It's a distinction investors need to know, and I'll highlight it in this week's main topic while revealing 5 stocks to buy in the unstoppable AI trend, along with important updates to shares of AGNC and IBM. But first, besides the AI stocks, there's another group of stocks I'm buying. In fact, I call these my forever stocks because I don't even have to research them anymore. I just let them run higher, and the proof is in the returns, with the group up an average 94% last year alone, with one of the picks up 100% last year and 125% already this year. I'll leave a link to that report on those stocks in the description below. The report is totally free. You're going to see the first stock immediately. They'll email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link. Back to those AI stocks though, and tech stocks got off to a rocky start last week after an accidental early release of the earnings by ASML sent semiconductor stocks into a tailspin. Now, ASML makes the equipment used to make semiconductors, the brains of any electronic device. While earnings and revenue did beat expectations, the company reported order bookings, which are a measure of future demand, that missed forecasts by a long shot. ASML bookings of $2.8 billion were about half of the $5.8 billion expected by analysts, and the company also downgraded its outlook for next year's sales by $5 to $10 billion. Of course, that sent investors to the exits fast on Tuesday, with ASML crashing 16%, the broader semiconductor ETF, the SOX, down 6%, shares of Nvidia even down 6% lower as well, before clawing back most of those by the close. But by Thursday, all was rainbows and unicorns once again, when the world's largest chip foundry, TSMC, posted earnings that jumped 54% from last year on sales that were 39% higher, and saying that the AI boom would continue for several years. Shares of TSM jumped double digits on the news, while Nvidia rebounded 5% that ended the week at a new high. And now to understand this divergence, you need to understand that not all semiconductor chips are created equal. The vast majority of the chip market are destined for non-AI devices like cell phones, laptops, and cars. In fact, Tabalt Lanu, an analyst at KBC Securities, estimates the AI-capable chips, like those put out by Nvidia and AMD, are just 7% of the market. Demand growth for those low-end chips is much slower than the high-powered chips capable of running the AI models. Estimates for sales growth of these low-end chips to be just 11% this year and 7% next, while the AI chip market is expected to double this year and grow at 74% next. That means investors betting on stocks across the chip market are likely to be disappointed. Instead, you need to understand the value chain in chips and who touches those AI-capable chips in demand. And while the chip makers like Nvidia and AMD have already seen that revenue boom, I'm following that supply chain into server manufacturing with companies like Supermicro, Dell, and HPE, and eventually into the users and productivity beneficiaries within the server manufacturing space, which again I think is the next big trend in that revenue growth as that insane demand for AI chips follows into the servers and the racks to fill those data centers. I'm watching those 3 specifically, Supermicro, Dell, and Hewlett-Packard Enterprise. In a revenue chart of the top 5 manufacturers, you can see the revenue growth has just started in the second quarter of the year, and I expect we're going to see a surprise higher this quarter as well. While Lenovo and Dell seem to have kept revenue fairly steady, it's HPE and especially SMCI that are seeing that strongest boost to their revenue. And while all server manufacturers, including Microsoft as well, have recently publicized their liquid cooling systems, it appears SMC has 1, a very good technology, perhaps even an edge in the market, but 2, also better marketing behind its equipment that is creating more buzz. It appears to be flowing through to actual orders, with the company reporting shipments for more than 100,000 AI-capable GPUs per quarter. Now, that competitive advantage aside, both Dell and HPE are trading for discounts on a price-to-revenue basis compared to shares of SMCI, but that could also be a function of their more diversified business model. Both Dell and HPE trade for a price at around 1 times their revenue, while Supermicro is at 1.9 times, which is still even cheaper than it was just earlier this year, but still relatively expensive. Now, SMCI is a pure play on this infrastructure hardware boom, while the other two players have significant revenue in other segments that might not be growing as fast, so you would expect them to trade more cheaply than SMCI. Of course, SMCI has problems the other two aren't facing, including a possible DOJ investigation into its accounting practices. Now, I've been buying the shares and do not think the allegations are a threat to the company's business, but there is that downside headline risk. That said, I'm still buying SMCI, but I'm also likely to pick up shares of HPE ahead of its earnings reported next month. I also think there's still good long-term potential earlier in the value chain for NVIDIA and AMD as well. While NVIDIA will continue to dominate the market for AI chips, AMD has a respectable IP and a relative valuation that is hard to ignore. While investors are paying a price of $35 for every dollar of revenue generated by NVIDIA, AMD investors are getting a steal, paying just 10x on a price-to-revenue basis. As NVIDIA struggles to keep up with that demand, I think enough customers are going to try out AMD chips to boost its growth, already forecast at 28% next year. Now, looking at the stocks I'm watching this week, Digital Realty Trust, ticker DLR, won't appear to be benefiting from that massive boom in data centers when it reports on Thursday, with analysts expecting earnings to fall to 88% last quarter from the period last year. Now, full-year earnings don't look any better, falling from $3 a share last year to just $1.66 per share this year, and further to $1.39 per share next year. Now, looking at that, you have to understand that earnings are a poor measure of a REIT's, a real estate investment trust, performance. But if we do look at the NAREIT report, the National Association of REITs, we see even funds from operation, that critical FFO measure, only expected to grow by 5.7% this year, slower than its peer Equinox. While the two data center stocks should benefit from those increased demand for AI operations, neither looks particularly cheap here. I do prefer the hardware plays, the companies making those servers and the other infrastructure that's going to go into the data centers, like the SMCI, the Dell, and the HPE that we talked about. I'm also watching AGNC Investment, ticker AGNC. It's also expected to report a drop in its earnings from last year, reporting 50 cents a share versus 65 cents per share in the quarter last year, though I think these MREITs are looking better along with the mortgage market. Now remember, those mortgage real estate investment trusts, or MREITs, they borrow on the overnight purchase rate. Then they use that money to buy the long-term mortgages as investments. Despite the increase in the long-term mortgage rate, you see a distinct weakness in the MREITs over the last 2 years, really on that Fed spike in interest rates, sending the mortgage market into chaos and really contributing to a 40% plunge in shares of AGNC. Earnings are expected to remain under pressure, but I think there is a good value in these shares and a stability in the 13.7% dividend that you don't see in many of these other high-yield stocks. International Business Machines, ticker IBM, is going to be reporting its earnings on Wednesday, with the tech giant having posted progressively bigger earnings surprises over the last 3 quarters, beating by 2.6% in the fourth quarter of last year to a surprise of 10% last quarter. Now, earnings estimates for this quarter haven't budged from $2.23 a share, about 11% growth from last year, and sales are only expected up 2.2% this year and about 5% next, which I think is a very easy bar to beat. IBM is also benefiting from that AI adoption theme, and at just 3.5 times on that price-to-revenue basis is a rare value play in this theme. Showing you that bigger picture here with the SectorSpiders.com sector tracker. 9 of the 11 stock sectors closed higher last week, with the rate-sensitive sectors, those utilities, real estate, and financials, really taking off. Now, while these sectors have done well on the build-up to that Fed rate cut and are expected to continue to outperform, it was odd they did so well last week when the rate on the 10-year Treasury was unchanged from the week before. It may signal stronger investor buy-in and momentum for this group. Energy stocks were the obvious laggard, with oil down 8% as Israel confirmed that it would not target Iranian oil assets in a military response. With oil supported on the economy and geopolitical risks, energy stocks could do well on a rebound. Looking at a longer trend here, while real estate stocks have given back some of this year's rebound in that last month, financials have jumped into the spotlight for rate-sensitive names. Now, I still like the deep value remaining in real estate after a few tough years, but it does look like the financials, the bank stocks, have the market's attention right now. Banks were expected to post abysmal Q3 earnings and have so far posted relatively upbeat numbers and an outlook which has helped relieve investors and bring that money back into the group. Get that free report and see the stocks I'm buying for the next 30 years. My forever stocks, up an average 94% last year alone, only with the link I'll leave in the description below. Or click on the video to the right to see my Frankenstein's Monster, SCHD. I took all the best stocks out of that dividend fund, to boost the yield by 50%. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.